Hello everyone, and thank you for joining our latest webinar. Today, obviously, we're going to be looking at the impact of Labour winning the general election and focusing on their manifesto or property manifesto to see what impact that'll have on the property market. So what we're going to cover today, if we can go to the next slide. So obviously, as I said, we're going to talk about the manifesto itself, look at some of the key points and see what impact that's going to have on the market. We're going to jump into a little bit of tax and economic impacts. We're going to talk about the mortgage market, mortgage rates, Bank of England base rate, and then by all means, there's some time at the end for some questions and answers. If you do have some questions during the webinar, please pop them into the questions section, and we'll get to those at the end. So who are we joined by? So obviously we've got myself, Andy Butts. I'm the New Homes and Investments Director here at Centrick. We've got our colleagues, John and Sean. Are you there, guys? Here we go. So John and Sean that are in Asia. And we've got two special guests today. So we've got Kat, who heads up our valuations department. I think very key today to talk about what impact the election and the changes in the manifesto might have on the valuations market. And also Neil Jensen, part of St James's Place. He's just rushed back to his home office just before this in Hong Kong. So thanks for making the effort, Neil. Very pleased to have you on board. Good. So if we kick off with the first slide. So the dust has settled. We're a week in now from Labour winning the election. So let's see what their manifesto has in store for us, in particular the property part of that. So we've pulled out a few key points here, and I think I'd like to kind of open the room, I suppose, to some thoughts around some of this. We've all obviously had a bit of time to digest it. We've been having some chats before, but starting with the first one, they pledged to build, like every other government, I think 1.5 million homes over the next 5 years. I think that equates to something like 1,150 homes a day, which is clearly a very steep target from what is almost a standing start. So Neil, anything in there that jumps out at you that you think might have an impact on values or the mortgage market in particular?
Not immediately. I think all of these are positive because there's a huge shortage in the market, but my view, Andy, is that I'll be very surprised if they achieve any of this in one single term. You're going to need huge patience to change this. I mean, it's like turning around an oil tanker. This is huge. I mean, planning's at an all-time low the last 20, 30 years. All of the builders are reporting that the projections for new builds are going down and the population's going up. So every year the demand gets greater and the supply gets less. So it's positive, but this isn't a magic wand. This is long term, and it will take a long time to do.
Yeah, we were talking before, weren't we, Sent, that there's no silver bullet. They've got to tick the box on many different areas, from planning to education to bring new builders and skills through, maybe even through working visas to allow some of these infrastructure projects and build projects actually come to life, as well as fixing the planning issue that we have, or the bottleneck.
I think in reality, in simple terms, Andy, they're going to have to be producing homes to the level that they haven't done for over 60 years in the UK. That's the scale of the task that we're looking at with these pledges on the screen right now.
Yeah. Kat, just to bring you in terms of a valuation perspective, any initial thoughts off the back of the election and the manifesto and some of those key points?
Yeah, sure. I mean, key to us as valuers, and sort of following on from Neil's comments, what do people look for when they're purchasing property? What adds value? The key things for us, which that they're nothing new, but they are of increasing importance: energy efficiency and ECG, infrastructure and transport. and access to schools and local services. All of these are the things that are key to improving value, and to us providing valuations at at the levels that the house builders want to achieve on their projects,
Yeah.
to ensure that they're viable.
And you were saying earlier that some lenders are actually asking you to look out for those things as part of the valuation report.
Yeah, that's right. So we produce over 1,000 valuation reports on an annual basis. Lenders are increasingly specific with their requirements around EPCs, energy efficiency, what impact this has on property values, and other items such as connectivity, in terms of Wi-Fi, super fast broadband. All of these things are the things that have a real impact on property values. So it's not just about building the homes; it's about building the community and the infrastructure around it.
The infrastructure and the quality as well. John and Sean, it's been hard for you to sit there, I'm sure, quiet being two salespeople. But it sounds like we're still going to have a supply and demand issue, which ultimately probably leads to long-term price increases like we've seen in the past.
Yeah, I think that imbalance may improve, but it's going to take a red decades to really get over it. So yeah, you've also got potentially building on greenfield sites, greenbelt, sorry, which is obviously contentious, which will probably take some doing. I'm sure there'll be a few people putting their hands up, or the eco warriors, so to speak, may get involved. But there's going to be some contentious stuff. But to make change, you have to be contentious, I think. So it's going to be some hard yards to be earned here. As an overseas investor myself, I'm based in Asia. I've been in Hong Kong for 18 years. We've seen things like no capital gains 15 years ago for overseas investors. Now there's proposed stamp duty increases in the manifesto. So that's something to look out for our investors who looking to make every pound, dollar count, every pound count as regards to investment. So look out for that potential stamp duty rise. And we'll, that's something to be highlighted specifically for overseas investors.
We've got a slide on that later to deep dive into that. Yeah. Sean, anything from your side in terms of what your clients have, or maybe a reaction that your clients have had?
Yeah, I think guys have covered a lot of it. I mean, the positive of it being a landslide, at least they can kind of go and do these things, right? Which is positive. It's not going to take a long time to get things through, which is great. The big thing, they're talking about is giving the local authorities a lot more power, but it comes back to how do you fund that, and it's the whole kind of not in my backyard thing, which is a very big thing about building on these green belt areas and things like that, right? So, but I think on the whole, it's a very positive thing. And, the Labour understand that property is a huge part of British life and British culture, don't they?
Yeah. And I think coming back to the local council, they're talking about actually giving the local councils build targets again. This can't all be done by the private sector. The local councils are going to have to be building themselves to hit these targets. So I think that's an interesting part of the future. Okay, cool. If we pop on to the next slide, then I think we've got a little bit around some of the key personnel in the cabinet that might make an impact here. So obviously we've got Sir Keir Starmer as the Prime Minister. I think looking at that, the person with probably the hardest job over the next few years is Matthew Pennycook, Housing Minister. I think, John, we were talking about a stat earlier about how many housing ministers there's been.
13 in 16 years. So it's kind of the poison chalice, the job that no one really wants to do, which just shows how hard it is as a job to kind of change. You've got a migration, which is on the up, and you've got no housing and no planning. So it's kind of a job that no one really wants. So good luck, Matthew, and hopefully he does a good job. But the odds are stacked against him if you look at that. Look at those track record.
Yeah, definitely. Okay, cool. I think, Sean, you're going to take the next few slides from here.
Pardon me. Cool. So yeah, just a little quick look at the kind of tax and economic impact. So first off, I wanted to look backwards a bit. So Looking at the last two elections, okay, so this is looking at the kind of pent up demand and the demand of buyers before and after the election. You can see the election month there, and the big thing there is that the as I said, the demand shoots up afterwards. If we go to the next slide, Callie, this is actually interestingly looking at the last five elections. Okay, so looking at the 12 months following the last five elections, and in those 12 months, on average, there's been a 4.6% growth. Okay, when that's been a majority, you see on the right is 6.9%, so more conservative 4.6% growth. Now, why is that? Of course, there's pent up demand. We do seem to see, usually it's the months leading up, but this is a quick election. So the month beforehand, people perhaps sitting on their hands a little bit, seeing what's going to happen. So there's a bit of pent up demand there. But the big thing, which I think is that there's stability in the market, whether you agree with it, going left or right, Labour, Conservatives, whatever you agree with, at least okay, this is where we're going to be for hopefully the next 4 years, as long as it all goes to plan. But at least people know where they're going to be, and that offers stability in that sense. So next slide. So looking forward, so that's looking backwards. Looking forward, okay, so this is a Savills forecast that came out at the end of May, early June. Okay, so interestingly, there's a lot of numbers there, but interestingly, on the top left, there's a UK, their expectation for the average price across the UK this year and over the next 5 years. Now, originally, when they did this forecast at the end of last year, they actually expected a 1.5% drop in the average price during 2024. Now, they've redone this halfway through the year, and they're actually saying they're expecting a 2.5% growth during 2024. Over the next 5 years, get on average 21.6%. Now, the hotspots we tend to look at, you look at London, bottom right, but the hotspots we tend to look at, West Midlands, Birmingham, East Midlands, Nottingham, Northwest, Manchester, these areas, they're all expected to outperform the UK average. And as those main cities in those areas, you'd expect them to outperform that area too. Next slide, please, Callie. Now, why is that? Again, we've probably hammered it home already. I didn't expect the guys to talk about it so much, but there is it's a problem in the UK. There's a chronic undersupply of properties. Okay, now the Tory government had this target of 300,000 properties that they needed to keep up with demand. They needed to do, and they consistently was not being hit. That's on average, 100 to 120,000 properties under what they needed. They actually scrapped this target a few years ago because they were kind of a bit embarrassed of not hitting it. And the local MPs were getting stick, and people had that "not in my backyard" kind of thing, which I said about just now. So they are going to bring these targets back in, but you add in that thing of last year there was a net migration of 900,000 people into the UK, coming to the UK. That's just further feeding into that kind of supply and demand issue, which is the massive kind of fundamental of price growth in the UK, short and in the long term. Next slide, please. Sure. So the guys touched on it just now. So all of these kind of good ideas, which are on the whole are great ideas. Then talking about 300 new planning officers, things like that. But how do you fund these things? So this isn't confirmed at all, but what they propose and what they've spoken about is funding these things by adding a 1% surcharge, I suppose, to the overseas buyers' stamp duty. Okay, now when would it come in? Again, it's not confirmed. When would it come in? We don't know. They can't call an autumn election. They can't call autumn budget until at least 100 days after the election. So it's going to be at least 100 days after the election. When they call that autumn budget, they could say, okay, starting from today. They could realistically probably next tax year, okay, which would be April next year. So that if you are, I guess, with that, if you are thinking of buying, then why not do it before that comes in and you're saving unnecessary money on stamp duty. But that's something definitely to keep your eye out on. As I said, it's not fully confirmed yet, but it's something to definitely keep your eye on. Next slide. I'm going to pass you across now to Neil Jensen, and he'll talk you through the mortgage process and mortgage market.
Thanks, Sean. Kelly, can we have the next slide, please? Here we go. So I've got on the left here a staircase to hell, which has been base rates over the last sort of 3 years. And of course, there was a lot of adverse media, as you'll know, of price crashes and where's this going to go. It was all linked to inflation. And the great news was that as we got towards the end of 2023, that started to level out. Now, talk has gone on to, well, rates are going to go down. And I have numerous conversations with buyers and people who have mortgages at the moment that say, oh, well, I'm going to wait because the mortgage rates are going to go down. You can see on the right-hand side, there was a quote from the Bank of England that clearly said that the bank rate is possible in the summer. Interestingly, the Bank of England haven't been allowed to make any statements between the time that the Conservatives called the general election and the general election. The only piece of news that came out of the Bank of England was the Monetary Policy Committee announced that base rate was staying at 5.25%. The next announcement is due in August. There is strong possibility, better than 90%, that the rate's going to come down. Most are expecting it at 0.25. You will read the odd article of 0.5. I think that's highly speculative. But there is a feeling that rates will come down. Can we have the next slide, please, Kelly? So we've got some rates on here in terms of where the market is, and we've got trackers on there. We've got fixed rates, 2 and 5 years. So if I take on the right-hand side, um, now these are for buyers who are based overseas. I'm based in Hong Kong. John and Sean obviously are overseas as well. We're dealing with foreign nationals, expats. These are the best rates on the market at the moment. So if you're saying, I'm going to wait, I want a variable rate, I want a tracker rate because I think that the rates are going to come down, then the rates on the right-hand side are what you're going to get. You could opt for a fixed rate. And I think the question you need to ask yourself is how far do you think that rates are going to come down? I don't believe they're going to fall by more than about 1%. And the best guide to that is the 5-year fixed rate, which you will see on the left-hand side. So you may feel it more prudent to actually go for one of those rates because you're getting that rate from day one. The base rate would have to come down to that sort of level. Well, 4.94 from 6.13, you're going to need it to come down by 1.25%. That's a lot over a period of time. So, look, the banks rarely get it wrong. What you've got to bear in mind that the fixed rates that are out there in the market at the moment are probably already pricing in what they expect to happen. I don't expect fixed rates to change when the base rate comes down because they're probably already pricing it with a strong feeling that it's already down. So I think rates are good. Back in the day before international fixed rates were common, I was ex-Lloyds Bank International, and I can tell you that the common rate that most or all of the international banks were charging was Bank of England base rate plus 1. So your guide on that would be 5.25 today, plus a 1%, 6.25. Always use that as your barometer, as what would be a fair rate. So I would say that those rates aren't too bad. Don't get carried away with the whole 1%, the 0.1. That was not only a once in a generation, I think that was once in many, many lifetimes. If you look at the average base rate over 200 years, these are really, really competitive rates. And I think they signify a strong economy, decent inflation rates that are controlled, and also employment. So don't be waiting for the 1% to come back. If the 1% to come back, then we've got massive, massive problems, and I don't believe that's the case.
Brilliant. Thank you, Neil. Kath, I know with what you do in terms of valuations, obviously base rates and mortgage rates are very, have a huge impact on your view on values. What are your thoughts on what Neil's just said, and would a base rate cut impact your opinion or your team's opinion on values?
Well, it would certainly impact our valuation activity. I think what we've seen as a team over the last, well, you know, I'm gonna go back sort of 4 years to COVID. Has been a very unpredictable market. You know, COVID, well, Brexit followed by COVID, followed by stamp duty cuts, followed by successive interest rate increases. People just haven't known what's going to happen next. And, you know, in those scenarios, that they don't do anything. As Neil says, you know, people tend to sit on their hands when there's not the certainty. The new government brings certainty from a kind of political point of view. The prospect of interest rates coming down sort of gives people more confidence. But sort of from speaking to my valuers and to peers in the industry, I think we feel that this is sort of the start of a return to normality, if you know, for want of a better expression. You know, valuers feel confident valuing in stable markets,
Yeah.
and that's not what we've seen for a number of years.
No, I think
Andy,
we'd
can
all
I,
welcome a sustained.
Andy, can I ask Kat a question?
Yeah, of course.
Kat, the what intrigued me, and I'm interested as to your thoughts as to where you think this might go, but obviously the Conservatives were going to bring a new rule about diesel cars and also EPC ratings for landlords, and it was going to be at the end of 2025. You couldn't sign a new tenancy agreement unless you had an EPC rating of C or
See,
above.
Yeah.
And of course,
Mm-hmm.
they scrapped that in late September last year. What's really interesting is that as it led up to that, international lenders, certainly Skipton International would be a good example. They basically said, we will not do a loan from now on a property that has a rating of worse than D, and it has to have the potential to C. Now, when the government scrapped all of this, I went back to the likes of Skipton and said, are you going to change your lending policy? And none of those lenders has changed their lending policy. So despite the fact that the law has changed and this requirement isn't officially coming in, do you suspect that this will come in at a certain point? Because the lenders aren't moving from the energy targets, which very much drives investors to buy new homes.
Yeah, I think the target of C was always going to be unachievable. You know, I don't think it was a surprise across the industry that they reneged on that. But that doesn't take away from the fact that energy efficiency is of increasing importance to homeowners and investors alike. And you know, in the last few years, we've seen energy costs and household bills rise astronomically. So when people are making property purchases, they're looking at the whole. You know, Neil, you'll know from like your assessing purchases. You know, you've got to look at affordability overall. It's not just about the mortgage and the interest and your ability to service that. It's about, you know, what's it costing you to live and exist in your house in a comfortable way. So yes, people are going to place an increasing importance on energy efficiency, as our lenders, to ensure that you know the market remains stable, and that you know that the property that we're valuing has, because that's the other query, that's the other question we're always asked in our valuation reports, is what's the economic life of this property.
So if you're buying an older property, just because it's been scrapped, it doesn't mean it's gone away forever, right?
Yeah, exactly. Yeah.
In somewhere in Labour's manifesto, there is actually a comment or a highlight of trying to re-establish that aim for a C or above EPC in the future. Obviously, I think everybody's looking at the net zero targets and trying to future-proof these properties. So, yeah, I think when investors are looking, particularly if they're hands-off investment, I think they need to be looking at new build, and they need to be looking for C and above. I think that's, John will probably come on to it now, but I think lenders are going to want to see it. And to answer that question, Neil, I think you all know that they're not going to go backwards, are they? I don't think they're going to be looking to lend on E's and F's for sure, because it's just probably not safe lending for them either.
They're always looking at risk, Andy. That's,
Yeah,
it's never a reward from a lender. It's really what happens if we end up with this property. We don't want it left on our hands, and yeah, I mean it's all of the
understandably,
above.
yeah.
If they were going to change it, they'd have changed it by now. So I don't see it changing, which makes me strongly suspect that this is going to come back at some point.
Yeah.
And it's market driven. It's people demanding, better energy efficiency, as well as it being, a regulation. It's that people want to live in energy efficient homes and
Yeah.
have control over their bills.
Yeah.
And
I think we're
people have
behind other countries.
environmental
Yeah, I
conscience.
think we're
Yeah,
behind
yeah.
other countries, aren't we? Other countries have been delivering properties at much higher EPC ratings for many years, and I think we've had some catching up to do. But we are seeing now, like the developers we're working with are aiming for A's and B's, which is great. I think everybody's got the message loud and clear, and we're having to up our game in terms of the the performance of these properties and what these developers are delivering to the market. Cheers, guys. John, do you want to take into this slide?
Yeah, absolutely. So obviously, a lot of discussion there, a lot of points. EPC, leveling up was mentioned. Working on brownfield sites, and we've got a current investment which we highlighted before the election. So we must have had a crystal ball to bring this kind of on. So Cooper Gate, this is a site in the West Midlands, Longbridge. So brownfield site, it used to be the Rover MG factory, which was the biggest employer, I believe, in the 70s, 80s in Birmingham. At one point, it was left derelict. Now, Sep Modwin, huge developer, FTSE 250 size company, have come in to regenerate and build it out. So at a glance, we've got 1 and 2 bedrooms here. This is perfect on the EPC. This is going to be targeting A or B. So it ticks all the boxes for Neil and hopefully for the valuers as well. It completes the first phase Q4, Q1 next year. So Q4 this year, Q1 next year. Prices from 187,000, just 15% on exchange. You've got connectivity. Me and Sean jumped on the train last week. We were in Birmingham and we were in the city centre in 14 minutes with just one stop at university. Lots of people got on from university, lecturer types. The QE is also a stop there, which is the biggest employer now in Birmingham, I believe, 25,000 people. So you've got a great catchment area, but post-COVID, people want more, as Kat alluded to. So your Wi-Fi, of course, things like that. You've got all that, but you've got greenery, you've got national parks, you've got golf clubs, cricket clubs, sailing clubs within a 5-minute drive of the location. So with people working from home once, twice a week, you can be in a city centre in 15 minutes. You don't pay a congestion charge because Birmingham's got one. You pay 20-30% less rent than the city centre, or 20-30% less for the actual property itself, and you've got all the amenities, and it ticks the boxes on energy efficiency. So this for us is a perfect sort of storm for investment, and this is our hot pick right now. Next slide, please. So obviously there's a lot of information there. This QR code on the right hand side will allow you to download more details about the project itself. We are running a Keir Starmer election special. It's not sponsored by Keir Starmer. It's basically July. We're offering free legal fees basically for purchases. The market is starting to. We expect it to pick up really a lot over the summer, where people just begin to realise what's happening in the market and then just look at the fundamentals. But for July, is an incentive, we're offering free legal fees. So please get in touch with us to discuss further about this project and more about Centrick Invest. So thanks a lot for your time, guys. We can now go into the Q&A.
Cool. Thanks, John. It was really useful. Callie, who's been behind the scenes running the show, has there been any questions that have landed?
Yes, I got a couple of questions here, Andy. So first one is, where do we see value given housing targets in relation to locations?
Sean, do you want to maybe take that one, coupled with
Sure, yeah.
Kat?
I think in the kind of private rental sector, I mentioned them earlier, but the big hotspots we target, like we do have properties in the likes of London and things like that, but the hotspots that we target are the likes of the kind of second tier cities. So you got Birmingham, Nottingham, Manchester, where you're getting a really nice balance between, if we look at London, the yields are low, and as we saw from the Savills forecast, the expected price growth is quite low. When you go to these, and for example, there are some areas in, say, the north of England, we can get a very high yield. There doesn't tend to be as much kind of government infrastructure investment, which means economic growth, companies moving there, things like that. Whereas in these cities like the Nottingham, like the Birmingham, like the Manchester, you have a nice balance of a yield between 5 to 6% rental yield. Then you're also getting a nice expected growth of 4 to 5% as well, which is a nice kind of balance between both. Because in my opinion, the price growth is where the real kind of money's made. But with interest rates higher, that rental yield is also important at the moment.
Kat, is there anything kind of on valuations that you'd say in terms of locations? I suppose coming back to areas of key infrastructure is probably going to echo what Sean said.
Yeah, exactly. Yeah, and I think Cooper Gate is a good example of a sort of best of both worlds, in that you've got amenities on your doorstep, you've got good connectivity into city centre, and you've also you're right next to the countryside, and with that scheme you've got residence parking. I think when you look at some of the city centres, you're not getting as sort of much of a you're not getting stuff like the parking, just because of the densities. So from a sustainability perspective, some of these slightly outer city centre schemes are probably where we sort of see sustainable values compared to city centres.
So
Yeah,
just to add on to that, as well, something I found very interesting when we were looking at sites, and we have our current sites and potential new sites. For every kind of 10 sites we look at, we probably take on one which we like and passes the DD. But the big thing that I found, and Andy, you were kind of letting us know, is that especially in the city centre, a lot of these places is very hard to get parking in the planning as well. So it does seem like these city centres, especially, they're trying to make them, they have a congestion charge in Birmingham now, for example, for cars which aren't green, and they're making it harder to get parking planning and stuff. So they're trying to make it more public transport and that kind of stuff, right? So people on their bike if the weather's good.
yeah, absolutely. I think there's a
Andy, if I can
Yeah, go on.
if I
Sorry,
can
Neil.
just add to what Sean's just said there, and also Kat, if you look at the state of play in the UK at the moment, post COVID, there isn't actually a lot of money. All of the plans for HS2 expansions and all the rest of it. If I were a buyer right now in the UK, I'd be looking at buying in a city where the work's been done, where the city tram's in place, where the extensions have all been done.
Yeah.
If you look at Birmingham with HS2, it's too far, pardon the pun, down the track to change it back. Therefore, where else in the UK are you going to get that level of growth and that level of spending done? I'm from Newcastle originally, and the last massive change was the Tyne and Wear Metro, which opened in 1981, and they've still got the original cars running on that track that they had 43 years ago. And that's not going to change, sadly. So therefore, Birmingham, Manchester, beyond that in the UK, where are you going to see the upgrades? That's genuinely my view, and I say that with some sadness. But if you're an investor, those are the places where the businesses are gonna go from because of the congestion charges. If you can get on and off a tram, the way that those are set up, they're amazing. And your commute to London from Birmingham, at what is it, John? 43 minutes it's going to be?
In
47,
49 minutes.
48 minutes. Yeah, it'd be game changing. That's like Zone 4 London time frames, which and this is the thing with that. It's a lot of speculation. But when it actually arrives, that's going to be a big day. It's going to be 2033, 35, I'd probably imagine, but that's going to give the market legs in Birmingham for a long time.
Yeah, no, Neil, I think that's a really, really good point, and probably one that you're obviously seeing come from a lot of your investors out there that are investing, and it's right to spot areas of infrastructure that are already in play. So yeah, really good. Callie, were there any other questions that come in?
Yep, so I've got one more for you here. When do you think stamp duty will rise for overseas buyers?
Okay. So John, I think
It's
you
the
already
golden
covered
question.
this, but you might want to reiterate it. And Neil, I think you had before we actually started, you had a couple of comments on that. So over to you guys.
Sean and Neil were the ones with the party line. I think.
Sorry, threw you under the bus there, but I'm sure you've got an opinion.
So
Look, I'll go. So they can't do this. They can't hold a budget for at least. They have to give 100 days notice to do this. Nobody knows what it will be. But I mean, stamp duty isn't huge. The amount of money that they get. I think last year it was 250 million, something like that, in terms of non-resident buyers. I'd have to check that. But so if that's at 2%, you put that up by 1%, 125 million. Is that really going to build you 300,000 or change it? So or employ 300 planning officers.
Planning officers.
I honestly, I really don't know. But one cautionary note from me. I live in Hong Kong in a place where they put cooling measures on, and John and Sean will resonate with this. For non-resident buyers, they put the stamp duty up as they have in other cities in the world, and they are cooling measures. Now, I don't think cooling is what this government needs right now, because it's all right building 300,000 properties, but who's going to buy them? And the non-residents do help the economy. No issue with them getting taxed, but people will only be pushed a certain way. And there are other countries where people would buy. Australia is very popular, and the rest. So the government cannot assume that non-residents will continue to pump money into the UK. They won't. So they have to be very, very careful how they handle this, that this is not a cash cow that's just going to keep swallowing tax rises.
Yeah, I'd agree with that. I think part of our conversations we've been having here that, a lot of these city centres, yes, there's a lot of building going on, but who's buying them? And it is a lot of offshore investment. But the argument to that is, well, if they weren't buying it, the prices wouldn't be so high. But then the developers couldn't build it because they can't get the value back out. So I think it is a fine balance, Neil. You're absolutely right, and one the government has to consider more carefully.
A cooling measure in Hong Kong is 20% stamp duty rise, so 1% comparison, and a maximum loan to value of 50%. So that's an ice cold measure. So that's what they did over here. 1%. It's just, look, if it happens, it will happen. But if you're in the market and you're looking to buy for your retirement, which most of our clients do, why wait? Just buy it and benefit before if it happens. So that's
Okay, so I'll leave you with this. So say, for instance, stamp duty goes up 1%, but in the meantime, the interest rates and the mortgage rates have come down 1%. Your stamp duty, that 1% is only once. At the moment, you're paying that extra 1% every year, and people are buying. Therefore, you can offset your stamp duty against your first year's rental income for tax and all the rest of it. It is deductible. I'm not going to talk that up, but put it into perspective that, yes, okay, it might be going up by 1%, but actually your mortgage is 1% cheaper, so it cancels it out.
Yeah, exactly.
I think another thing worth noting, which we haven't really touched on, is just the strength of the rental market in cities, but like Birmingham, where we're active, but also Manchester, Nottingham, etc. That there's been an enormous growth in rents over the last couple of years, and people delaying becoming homeowners. So there is a need. There's a much stronger need for investors because someone's got to be the landlord.
Yeah, exactly. Yeah. Oh, clearly not moved long enough. Yeah, absolutely. We are becoming a nation of renters, aren't we? I think we're becoming very European in that way, or renting for longer before we buy our first home. And I think I read a stat that the average 30-year-old will have something like 14 or 15 jobs in that period, and most likely across 4 to 5 different cities and towns. So people are wanting the flexibility of moving around and not being shackled by a mortgage and a home until a bit later in life. So, like you said, Kat, the local councils and the government aren't going to have the housing options. So I think it's going back to what Neil said. If there isn't a private rental sector, then the government are in a real pickle, because there's just not going to be enough rental property to go around. So yeah, interesting stats. Okay, guys, thank you very much for your time today. Callie, I don't think, is there any other questions that have come in?
No, that's everything.
Brilliant. Okay then, guys, well, thanks for your time as always, and yeah, hope to see you on the next one.
Thanks,
Cheers, all.
everyone.
Cheers, guys.